The paper price just dropped to 61.75. The banks want you to believe the rally is cooling off. They want you to believe silver is just another speculative trade that's running out of steam. They are lying to you, not a small lie. This is a lie of omission so massive it borders on criminal negligence. While you were watching the COMEX ticker yesterday, while the algorithms were shaving a few dollars off the paper price in New York, something happened in London and Zurich that makes the paper price completely irrelevant. Something happened that exposes the fatal crack in the global silver market. We are now entering stage 3 of the historic 4-stage cycle, the stage where physical silver starts to disappear and nobody is ready for what comes next. To understand what just happened, you need to know something most investors don't. When you see the silver price on your screen, you're not looking at the price of silver. You're looking at the price of a promise. For 40 years, the system has convinced you that paper, silver, and physical silver are the same thing. They are not. Paper silver is a futures contract, an ETF share, an unallocated account. It's a number on a screen. Physical silver is metal you can hold, and when the crisis hits, only one of these matters. Think of it like airline tickets. The airline sells 100 tickets for a plane with 80 seats. That works until everyone shows up. The silver market has sold far more paper claims than there is metal to back them up. And right now, people are showing up at the gate. Here's the proof. In November, HSBC London stopped selling physical silver bars to retail clients. No announcement. They just stopped. JP Morgan London followed. Orders are now delayed 4 to 6 weeks. UBS Zurich is turning away buyers. The premium on Silver Eagles just hit $8 over spot, the highest in history. Then there's backwardation. Normally, silver for future delivery costs more than spot, but right now it's flipped. Spot costs more than futures. The market will pay extra to have metal now, not later. That only happens when people fear they won't get it at all. The COMEX registered inventory has collapsed from 80 million ounces in 2023 to under 45 million today. That's a 43% drop. Meanwhile, paper claims are at all-time highs. Do you see the problem? If you own paper silver, can you hold it right now? If the answer is no, you don't own silver. You own a claim on silver. And claims are only as good as the institution backing them. This isn't speculation. This is documented by the London Bullion Market Association. You might think, I'll just sell my ETF and buy coins when I need to. But that's the trap. When everyone tries to exit paper at once, the physical market locks up, premiums explode, dealers run out, mints ration supply. You're left holding a screen number while others hold metal. The lie of omission is this. They never told you paper and physical are two different markets. They never told you one can collapse while the other skyrockets. They let you believe the COMEX price is real. It's not. It's the price of a derivative. The real price is what you pay when you take possession, and that price is diverging violently. Every manipulated commodity market follows the same 4-stage pattern. If you understand where we are, you'll understand why the next 12 months will be historic. Stage 1. Setup. A small group consolidates control. They accumulate physical quietly while prices are boring. In silver, this was 2000 to 2010. The big banks built positions, controlled warehouses and exchanges. Stage 2, manipulation. They suppress prices using paper contracts, flood the market with futures and derivatives, keep prices low while accumulating physical. Profit both sides, short paper and buy metal. This lasted from 2010 to 2024. Stage 3, squeeze. Physical supply runs out. Industrial users panic. Buyers demand delivery. Paper can't suppress anymore because real metal is vanishing. Spreads widen, premiums spike, vaults empty, backwardation appears. Banks stop selling retail. This is where we are now. Stage 4, collapse. Paper market freezes or settles for cash. Futures expire worthless or pay dollars instead of metal. Physical price detaches and goes vertical, but you can't buy it at any price. Metal becomes unobtainable. Those holding physical multiply wealth. Those holding paper watch it vanish. History proves this. March 17, 1980. The Hunt brothers accumulated 200 million ounces and demanded delivery. Silver went from $6 to 50. COMEX held an emergency meeting and changed the rules. Silver Rule 7 banned new purchases, only allowed selling. Paper price collapsed to $10 in 2 months, but physical silver disappeared. Dealers had nothing. Premiums hit 40%. People holding metal didn't sell. Paper died. Physical survived. Palladium in 2000. Russia stopped selling from state reserves. The market panicked. Palladium jumped from 200 to 1,100 in 18 months. Auto manufacturers bid against each other for supply. Futures became irrelevant. Only physical mattered. Cobalt 2017. China tightened supply for batteries. Cobalt tripled in a year. Contracts meant nothing. Physical access was everything. We're in stage 3 now. Backwardation that won't quit. Banks refusing sales, COMEX inventories collapsing, premiums at records, lease rates spiking. This isn't temporary. This is the shift from paper control to physical scarcity. What makes this different? In 80, one family squeezed the market. COMEX changed rules and crushed them. Today, it's millions of retail investors, nations and industry demanding physical together. You can't ban solar manufacturers from buying. You can't tell Tesla not to source battery metal. The demand is structural, global, irreversible. Stage 4 is coming. Paper will collapse or freeze. Physical will hit levels that seem absurd, 100, 150, maybe more. But you won't find it. The window to shift from paper to physical is closing now, not next year, not next quarter, because once stage 4 starts, the gate slams. Everyone holding claims instead of metal gets left behind. Now we run the numbers. This isn't sentiment, this is math. And the math says we're heading for a supply crisis that cannot be solved. Start with supply. Global mine production, 830 million ounces per year, flat for a decade. Recycling adds 180 million. Total supply, 1.01 billion ounces. Here's the problem. Only 30% comes from primary silver mines. 70% is byproduct from copper, zinc and lead. If copper prices fall, those mines close. Silver falls too, regardless of silver prices. You can't mine silver if the host metal isn't profitable. Peru and Mexico produce half the world's silver. Both face strikes, environmental laws and instability. Production is falling. Now demand, industrial use, 650 million ounces. Solar takes 150 million, growing 20% yearly. Electronics and 5G, 100 million. Medical applications, 60 million. New battery tech could add 50 to 100 million if scaled. Jewelry and silverware, 200 million. Investment, 250 million. Total demand, 1.1 billion ounces. We're already 90 to 100 million ounces short annually. That deficit drains stockpiles. But stockpiles are almost empty. Looking ahead, if solid-state batteries capture 20% of EVs by 2027, add 100 million ounces. If solar grows at 20%, add 30 to 50 million yearly. The deficit doesn't stay at 100. It jumps to 200, maybe 300 million annually. Picture a pool. You pump in 1,010 gallons yearly. You drain 1,200. The pool empties. You can't pump faster. The mines can't produce more. Geology won't allow it. If oil had a 10% deficit, prices spike instantly. Silver has 20%, yet paper markets pretend it's fine. Why? Wall Street uses spreadsheets from 2020. They don't see the shift. They modeled 2% linear growth. They missed the step change from solar, EVs and data centers. Same mistake as palladium. In 2000, analysts said supply would easily meet demand. Then auto catalysts switched to palladium. Price went from 200 to 3,000. Experts were 10 years late. We're seeing the same setup. The bomb detonated in labs and factories. The shockwave hasn't hit price yet, but it's coming. The scramble won't be Reddit buyers. It'll be Ford, GM, Samsung and Panasonic locking multi-year contracts. They won't bid 62. They'll bid whatever it takes. You think recycling will save us? It won't. But understand this first. The extinction math is locked. There's not enough silver on Earth for industrial demand alone. Forget investment. Forget jewelry. Just solar plus EVs plus 5G will consume 100% of mine supply within 3 years. When industry realizes they're competing for a finite, depleting resource, price doesn't rise gradually. It goes parabolic, then it goes dark. Companies stop selling. They hoard for production lines. The metal becomes strategic, not tradable. That's the extinction equation. Demand is inelastic, supply is capped, inventory is gone, time is running out. The optimists will say recycling will fill the gap. They're wrong. And understanding why is critical. Gold recycles at 90%. Silver recycles at under 20%. Why the difference? Concentration. Gold is concentrated. A wedding ring has 5 grams. A gold bar has hundreds. When gold prices rise, people melt jewelry and sell. Collection is economical. Refining is profitable. Silver is dispersed. Your phone has 0.1 grams. Your laptop, 0.5. A solar panel has a nanolayer film. A missile guidance chip has micrograms. It costs more in energy and labor to extract that silver than the metal is worth. So it goes to landfills. We're literally burying billions of ounces back into the earth in a form that's impossible to recover economically. The recycling rate has been stuck at 180 million ounces for 5 years. It's not rising because industrial silver is too scattered to reclaim. Then there's the time problem. Silver going into a solar panel in 2025 gets recycled in 2045 when the panel dies after 20 years. Silver in a solid-state battery installed 2027 gets recycled in 2042. The silver entering technology today is locked away for 15 to 25 years. It's removed from supply for a generation. The recycling wave everyone hopes for won't arrive in time to save us from the shortage of the 20s and 30s. The deficit is now. The sequestration is long-term. So the only solution is more mining. But can we just dig more? If silver hits $100, won't miners flood supply? No, this is the geological wall. You cannot print a silver mine. Discovery to production takes 10 to 15 years. A deposit found today won't produce a single ounce until 2035. Samsung needs silver now. Tesla needs it now. Existing mines are dying. Ore grades collapsed. In 2005, a good mine had 15 ounces per ton. Today, 4 ounces per ton. We dig 4 times more rock for the same silver. That needs more diesel, water, labor. It's exponentially harder and more expensive. Then there's politics. Mexico produces 25% of global silver. The government stopped issuing new open-pit permits. Peru faces constant strikes. Russia is sanctioned. Precisely when the silver-carbon anode demands 100 million new ounces, global mining supply threatens to shrink. This is a pincer. Demand exploding, supply collapsing, inventory buffer gone. No relief valve, no elasticity. The only thing that can adjust is price. But even price has limits. At a certain point, price can't summon supply that doesn't exist. That's when markets break. That's when silver becomes unobtainable. You've been told recycling is the answer. It's not. Recycling is a myth that gives politicians false security. The solution everyone's counting on doesn't exist. There's no way out except price, and price is about to do something violent. The theory is one thing, the reality is happening now. Here's the evidence that physical silver is vanishing while you're being told everything's fine. November 2025. HSBC London stopped selling silver bars to retail clients. No press release, no warning. Quiet policy change. If you're not high net worth, you're locked out. JP Morgan's London desk followed. They're limiting order sizes, serving institutional accounts only. Retail buyers blocked. Orders that do go through are delayed 4 to 6 weeks. UBS in Zurich has a waiting list. You want a 1,000-ounce bar? Get in line 4 to 6 weeks if you're lucky. They stopped selling. They delayed orders. They raised barriers. Now look at premiums. American Silver Eagles are trading at spot plus $8 to $10, highest premium in history. Canadian Maple Leafs, spot plus 6 to 8. Even generic rounds are spot plus 4 to 5. Premiums are the market's truth serum. When physical is scarce, premiums explode. Dealers can't keep inventory. They're paying more to restock. That cost passes to you. An $8 premium on $62 spot is a 13% markup. That doesn't happen unless supply is genuinely tight. Then there's backwardation. Normally, silver for delivery 3 months out costs more than spot. That's contango, reflecting storage and interest costs. But right now, it's backwards. Spot silver costs more than futures. The market will pay extra to have metal now instead of waiting. Backwardation only shows up before crisis. It means the market doesn't trust future delivery. People want possession immediately. It's a fear signal. The COMEX vaults tell the same story. Registered inventory stood at 80 million ounces in 2023. Today, it's 45 million. 44% collapse in 2 years. Meanwhile, open interest is near record highs. More claims? Less metal? If even a fraction of those paper claims demand physical delivery at once, COMEX doesn't have the silver. Cash settlement or default, that's not speculation. That's arithmetic. Government mints are struggling too. US Mint suspended Silver Eagle production multiple times in 2025. They cited blank shortages, but the real issue is demand overwhelming capacity. Royal Canadian Mint is running 3 to 4 weeks behind. Perth Mint in Australia imposed purchase limits. They stopped selling. They delayed orders. They raised premiums. They imposed limits. You might think this is temporary, a supply chain hiccup that'll resolve. But compare to 1980. COMEX changed the rules publicly. They implemented Silver Rule 7 and banned new purchases to stop the hunts. Today, the banks are doing the same thing quietly. It's a soft ban, no announcement, no rule change. They just stop selling to retail, they delay orders, they make it inconvenient. The effect is identical. They're rationing physical silver without admitting there's a shortage. The window is closing. Not next year, not next quarter, this week. If the banks themselves won't sell, where exactly do you think you'll buy when the real panic starts? To understand what's coming, you need to understand 1980, because we're living through the sequel, and this time, the ending will be very different. 1973 to 79. The Hunt brothers, Nelson Bunker and William Herbert, started accumulating silver. They bought futures contracts on COMEX, then demanded physical delivery. They pulled the metal from vaults and stored it privately. Over 6 years, they accumulated 200 million ounces, 10% of global annual supply. Their strategy was simple: buy paper, take delivery, remove metal from circulation, force the shorts to cover in a shrinking market. Silver went from $6 in 79 to 50 by January 80. 700% in 18 months. March 21st, 1980. COMEX held an emergency meeting by morning Silver Rule 7. The rule banned all new long positions. You could only sell. Existing longs had to liquidate. They changed the rules mid-game. Paper price collapsed from 50 to 10 in 2 months. Futures holders were wiped out. Options expired, worthless. But physical holders didn't lose. The Hunts still owned 200 million ounces of real metal. Dealers had no inventory. Premiums hit 40%. You wanted a coin? You paid 70 when paper said 10. Paper market died. Physical survived. Compared to today, in 80, one family squeezed the market. COMEX had a target. Change rules, crush the Hunts, done. Today, millions of retail investors, sovereign funds, solar manufacturers, EV battery producers, data centers, defense contractors, all demanding physical simultaneously. You can't ban industry from buying. Demand is structural, global, unstoppable. COMEX can't change rules because there's no single villain. This isn't manipulation. It's supply and demand hitting geology. When COMEX runs out of registered silver, 3 options: cash settlement, pay dollars, not metal. Paper collapses, physical unobtainable. Suspend trading, panic. Default outright. Any outcome means paper fails, physical goes parabolic. 200 to 500% in months. History says physical holders survive, paper doesn't. Possession beats promises. That's the documented lesson of 80. We're about to relearn it 10 times larger. They changed rules once. This time they can't change physics. There's only so much silver in the ground. It's running out. Let's make this crystal clear. There are 2 types of silver assets. They are not the same, and when the crisis hits, only one of them will matter: paper silver. This is an ETF like SLV. You own shares, not metal. It's an unallocated bank account. The bank promises you have silver, but your name isn't on any specific bar. It's a futures contract. You agree to buy silver later. 95% settle for cash, not delivery. It's a mining stock. You own equity in a company, not the commodity itself. Paper silver is a claim. It's a promise that someone else will give you silver if you ask for it. But in a crisis, promises break. Physical silver. This is a coin. American Eagle, Maple Leaf, Philharmonic. It's a bar. 10 ounces, 100, 1,000. It's metal you hold or store in a vault with your name engraved on it. Physical silver is possession. It's yours. No counterparty risk. No dependence on a bank staying solvent or an exchange honoring contracts. Here's the difference. If your bank goes bankrupt, your unallocated silver disappears. You're an unsecured creditor. You get in line with everyone else. If COMEX runs out of metal and settles your futures contract for cash, you get dollars. But by then, physical silver has doubled or tripled. You miss the move. If the ETF you own doesn't actually have the silver it claims, you find out too late. You get a fraction of your investment back in depreciated currency. Physical silver? It sits in your safe or in a private vault with allocated storage. It doesn't vanish if a bank fails. It doesn't get diluted if an ETF runs short. It doesn't settle for cash. It's metal, and metal doesn't lie. Think of it this way. Paper is an IOU. I owe you. Physical is you own it. In calm times, that distinction doesn't matter. But in a crisis, it's everything. If the financial system collapses tomorrow, what would you rather have? A piece of paper saying you own silver, or a bar of silver in your hand? In a crisis, paper burns, metal survives. That's not a metaphor, that's history. Gold owners in Weimar Germany, in Zimbabwe, in Argentina, in Lebanon. The people holding physical metal preserved wealth. The people holding paper watched it evaporate. The choice is yours. But the window to make it is closing fast. You understand the problem. Now here's the playbook. This isn't vague advice. This is step by step. Step 1. 1, assess your situation. What percentage of your assets is in precious metals? If it's under 5%, you're underexposed for what's coming. Consider increasing to 10 to 20% depending on your risk tolerance. If everything you own is in ETFs or paper silver, move at least 50% into physical immediately. Step 2. Buy the right kind of physical. Priority goes to government coins. American Silver Eagle, Canadian Maple Leaf, Austrian Philharmonic. Why? They're recognized globally. Easy to sell. Premiums are lower than collectibles. Avoid numismatics. Rare coins, limited editions, collectibles. In a crisis, only melt value matters. Nobody cares about rarity when they need metal. If you have a larger budget, consider 10-ounce or 100-ounce bars. Lower premiums, easier to store. Step 3. Store it safely. Do not keep everything in a bank safe deposit box. In 1933, the US government confiscated gold. Banks were ordered to freeze access. It can happen again. Instead, split your storage into 3 locations. 40% at home in a high-quality safe, hidden and secure. 30% in a private vault outside the banking system. 30% in an allocated international account if you trust the provider. Step 4. Don't over-leverage. Do not borrow money to buy silver. Do not put every dollar into metal. Keep 6 months of cash for living expenses. Silver is insurance, not a lottery ticket. You're protecting wealth, not gambling. Step 5. Timing. The window is closing, but don't panic buy everything in one day. Use dollar cost averaging. Buy a set amount every month. If the price dips 5 to 10%, buy more. Those dips are your last chance before the real move begins. But don't wait for the perfect entry. Waiting for 55 when it's at 62 might mean you never get in before it hits 90. If you have $10,000 to allocate, here's how I'd structure it. $4,000 into government coins, American Eagles or Maples, $3,000 into 10-ounce bars. $2,000 held in cash to buy dips, $1,000 for premium flexibility and transaction costs. Don't do this. Don't buy collectibles. Don't store everything in one place. Don't borrow to buy. Don't wait for the collapse to start moving. You have the knowledge, you have the time, but barely. The question is whether you'll act or whether you'll watch from the sidelines as the window slams shut. Let's bring it all together. You've seen the evidence. Paper silver and physical silver are not the same. The paper market is a promise. The physical market is possession. And right now, possession is becoming impossible. We are in stage 3 of the historic 4-stage cycle, the squeeze. Physical supply is vanishing. Banks have stopped selling to retail. Premiums are at record highs. Backwardation is screaming shortage. COMEX registered inventory has collapsed 44%. Government mints can't keep up. The math is undeniable. Global supply is 1 billion ounces per year. Demand is 1.1 billion and rising. The deficit is 90 to 100 million ounces annually, filled by draining stockpiles that are almost empty. Solar, electric vehicles, batteries and data centers are adding 100 to 200 million ounces of new structural demand. There is not enough silver on Earth to meet what's coming. Recycling won't save us. It's stuck at 180 million ounces because industrial silver is too dispersed to reclaim. New mining won't save us. It takes 15 years to bring a new mine online and ore grades are collapsing. The only variable that can adjust is price. And when price adjusts, it won't move gradually. It will spike violently. History has shown us this before. The Hunt brothers in 1980 proved it. When the physical market runs dry, paper collapses and metal becomes unobtainable. Those holding physical survived. Those holding paper were wiped out. This is not investment advice. This is a warning about reality. If you don't own physical silver, act this week. If you're holding paper, consider converting before it's too late. The banks know what's happening. That's why they've stopped selling. The mints know. That's why they're rationing. The industrial users know. That's why they're locking long-term contracts. The only people who don't know are the ones still watching the COMEX ticker, thinking it represents the real price of silver. Paper silver is failing. Physical silver is disappearing. The window is closing. Not in 6 months, not in 3. Now, when it shuts completely, price won't matter. Availability will. The choice is yours. Physics always wins. Paper always fails. Choose wisely.